Let's move into our last segment here, Tyler. And every Wednesday we have this fun thing we do where you get to dive into something in the options market, whether it's a strategy or two different strategies where you cross compare. We do it in different ways. Sometimes you highlight implied volatility cycles, things that were related to options trading out there. And Coach Tyler is one of the best options educators and traders that I've known in my career. So we created this segment we call Jedi Options. And Tyler, you're going to highlight one of the banking stocks that actually Coach Matt made a focus of yesterday when we were in our Queen's Court bit of analysis. Tell us what you got here for Jedi Options here today.
Yeah, so banks in general, these get grouped into value stocks and or cyclicals. These have done very well during the reopening. They're also connected to inflation and, more importantly, interest rates. So rising long-term rates tend to boost banks. One of the reasons they fell out of favor here recently is because when you look at interest rates, specifically the 10-year yield, that has dropped considerably. So took the wind out of the sails of bank stocks, which means you got a pretty big pullback in some of these bank stocks, right? Which, if you're tapping into your inner Mark, you're saying, hey, I wanted a pullback. And unlike Mark, I'll settle for a 20% drop versus 90%. Maybe I'll do something here. So with that in mind, you take a look at the financial sector. I will say I do like the bounce back. Financials, banks have fired back here, so haven't been completely left for dead. So I think bottom fishing in financials makes sense, right? I kind of like the just the thought process of where Matt was at with KeyBank on the fundamental side. And you look at the technicals, looking at the weekly chart, this is where the case is the strongest from a technical perspective. From a percentage perspective, 2365. I think this will be worth adding here. So 2365 was the peak. 2365. This week's low, which would be Monday's low, 1790. You're 24% off the highs. That qualifies as a pretty substantial dip. You take 2020 out of this and the pandemic, and KeyBank has been stable and a dip, a good buy on substantial dips like this. So you got the 50-week moving average coming in. I love the bullish hammer candle this week. So I think you've got a pretty compelling entry point here, and you have some confirmation based off the fire off of support. What you will see that makes some people maybe a little skittish is you've yet to see the daily trend turn back up. So from a trigger perspective, you just kind of have to decide how important that is to you. This is going to be a longer term trade where we're going to be in this for a couple of months. I'm willing to give myself a little more room for error and not be as OCD about having a perfect entry price. If somebody wants to wait for this to take out the 20 MA, fine. I like the strength of the fire back off of earnings as well. I think that was one of the main reasons Matt brought this up the other day. Really good fire back on good earnings. So just like we said with like Coca-Cola, some of these other good earnings announcements, just makes you more confident that it's going to turn and go higher, that this sell-off is a buying opportunity because they just reiterated, hey, we're a good company, our earnings are good. That should boost the stock for the next quarter. All right, so that's the pitch from a technical and fundamental perspective, and that's kind of where the sector's at. The question is, how do you want to play this? I think it goes up longer term. How do I want to play it? Well, first of all, it's a $19 stock, very cheap, which gives me the ability to do a lot of different things. I don't have to, I feel like our options are somewhat limited when we're dealing with something like Amazon, $1,000 stock. With this, you can do darn near anything. And so for me, I look at implied volatility to get a sense of maybe what might be a good fit strategy-wise. The IB rank isn't all that high right now. If it were, maybe we'd just sell some puts and be done with it. But the IB rank is low, and I want to build a trade where I can give this time, a couple of months. So what comes to mind is a bull call diagonal spread, which is similar in nature to a covered call. So similar, in fact, that if you build it a certain way, we often refer to it as a poor boys covered call. And so what I'm hoping this next little 5-minute conversation will do is help the listeners understand how a bull call diagonal spread, a poor voice covered call can be a very simple trade. Don't have to overthink this. So the first thing I'm going to do is I'm going to go buy a longer term in the money call option. Because I'm long term, I want to be bullish. I'm going to go buy a long term in the money call. And when I do this, if I'm trying to create a poor voice covered call and make this a substitute for buying the stock and then selling covered calls, I got to buy a call option that's a good substitute for the stock, that's a good proxy for the stock, that behaves kind of like the stock would behave. And the easiest way to understand that is to realize that when you buy 100 shares of stock, you get a 100 delta. And so if I'm going to buy a call option that I want to behave somewhat like stock, I can't buy a 20 delta call option because stock is 100 delta. I need to buy a call option with a higher delta, closer to 100. So it turns out, though, that you don't need 100 delta. I mean, that's pretty expensive to go that deep in the money. You buy around like a 70 delta call and you're probably pretty good. More on that in a second. From a month perspective, I don't want to buy September because I want to go a little further out in time. December for me is sufficient. If somebody wanted to go to January, that'd be fine. But if I buy a December call, I can sell August against it. I can sell September against it. I can sell October against it. At least 3 months, and I think that's sufficient. Maybe I'll sell November. We'll see. But that gives me enough time based on my expectation here. So looking at the December options, looking at the delta column, again, it's got to be a higher delta call to be that good stock substitute. I would probably either buy the 17 strike call. It's got a 76 delta. Might even be able to cheat a little bit and buy the 67 delta call. I still think that's going to be high enough to behave like stock. But just to make this as clean as I can, let's buy the 17 delta call. It's going to cost me $3. It's cheap, very cheap, for two reasons. I mean, number one, it's far cheaper than buying 100 shares of stock. That cost you $1,900. And number two, it's just a cheap stock. So calls in general are going to be cheaper. So I'm going to buy that for about $3. And I could leave it at that, right? I could say, hey, we like the dip. We like the weekly chart. Let's just straight buy calls. But the challenge is that's a really aggressive trade. And I don't know that I want to be really aggressive. So to tune this down a little bit, or to tone it down a little bit, we're going to sell a short-term call against it. So, and I would just use the same logic I use on a covered call. So normally on a covered call, you sell maybe 30 days out, sell an out of the money call option. If you have the tackle 25 system, we usually teach a delta around 40. 30 to 40, I think, is kind of the ballpark. So looking at what's available, I got a 30 delta call or 29 delta call here, or a 40 delta call. I want to give this room to bounce. And, you got 30 days. So I'm going to go to the 30 delta, pick up about 30 cents. Okay. That's going to reduce my cost by about 10%. Okay, so it's going to reduce my cost a little bit. So if I control click on the bid, that's going to sell the AUG call against the December that I purchased. This is the structure of a bull call diagonal spread. If I right click and analyze, it's going to give me the risk graph. And this is it right here. So for those that understand what the risk graph of a cover call looks like, this is similar. If the stock goes nowhere, looking down here, stock goes nowhere, I'll make about $20. Okay, if the stock heads up towards 2050, could make as much as about $100, which on a $2.73 trade, $20, I don't know, 8%. If we go nowhere, if the stock heads up towards 2050, you're over a 33% return. Those numbers are far better than what they would have been on a traditional covered call. So game plan here, final piece, I'm going to let this ride close to August expiration. Ideally, stock heads up towards 2050. And then I'll look to buy back the August call if it's in the money. If it's not in the money, I'll probably buy back at a nickel or something. From a risk perspective, my max loss is what I paid. But if I wanted to reduce the risk, I could say, hey, if this breaks a major support zone, maybe the 50-week moving average, call it $17.50. If it take that out, maybe I don't like it anymore. My risk is maybe $100, which would, be far less than the 273. So that's kind of where my head's at on this trade. Give me your feedback.
Well, let's bring everybody back in here for a minute. And obviously, if we go back to the chart on KeyBank, there's a couple things I want to highlight. Number one, this was an earnings response. Part of the reason why Coach Matt liked it so much yesterday was the basis of their earnings. And Tyler, I think is a good point that you brought up as to why it's been maybe out of favor for a little bit. As interest rates drug down, there's correlation there. Matt, what do you think about the diagonal spread here post earnings?
Well, I did like Key based on the raw earnings numbers, but it wasn't just the raw earnings numbers. It's the fact that it's, the financial sector in general is having a very good earnings season so far, in my opinion. And unlike other seasons where the financial sector was in a different technical condition, the financial sector was under a little bit of pressure coming into earnings season. And so I do like Key around that 200-day moving average. I like the response yesterday. The bullish engulfing candle following earnings I felt was very, very strong. But then when you look at, again, I don't want to go too much detail because we did talk about Key yesterday. But when you look at their fundamentals, like you're seeing a stock that has a 11P ratio, a 9.74 P ratio, a PEG of 96, and a price to book of 117. Those are Warren Buffett type value numbers, guys. That is wonderful, wonderful fundamentals. And so I do think after the substantial drop in Key coming into the 200-day moving average, a fired back response to their earnings report yesterday, were all very positive indicators of this stock has found a little bit of a bottom here. And even though I don't like Key from a directional perspective, Key is a cash flow type instrument for me. When you're comparing the covered call versus the port, like Tyler would call the poor boys covered call, the diagonal call, where you're substituting the stock for the call option, when you compare those two, and Key's a good covered call stock as well, you could go out right now following this earnings report, buy KeyCorp for $19.53, buy 100 shares, have a cost basis of when you don't use margin at all, we call that unmargined.
We have a lot of words flying
when you're
around here today.
Unmargined, that would be a $1,954 cost. And you could go out there and you could do that traditional covered call system in the Tackle 25, and you could sell a short-term call against that 0.40 delta, and you could bring yourself in a nice $50 in cash flow right now, and you hypothetically are telling the market that you're willing to sell it at $20. That would result in a $50 in cash flow per call option, 2.5% return on investment. Nobody's going to shake a leg at that. Nobody's going to be like, oh, wait, that's not good.
Matt, plus theoretically, the extra $50 on the called up went up to a 5% if you got called out.
Yeah, if you get called out, you sell it at 20 and you reset the parameter
return.
5%. That's a fantastic scenario. But what the Jedi is doing in Jedi options here, Tyler Craig, I'm going to have to change his name from the architect to like something that, what Jedi would Tyler? I'm going to have to think about that. What Jedi Tyler would be. He can't be Obi-Wan.
Mace Windu.
He can be somebody else. No, we'll talk about that later. Let's
Lots of
not
speculation.
sidetrack my point.
All right.
My point is this. What the Jedi just showed all of us is how, with a little bit of understanding of the dynamics of the options market, where you could substitute the stock, and instead of putting out $1,954 to own the 100 shares of stock, you can dramatically reduce that by going out in time, buying a call option, reducing your cost basis by 85%. So you're reducing your cost basis, and that doesn't. And to the trader, to the new trader, you're like, oh, now I can afford it. That's to the trader. They now have $1,700 to go do more trades with. That's to the trader. And so what Tyler is saying is we can reduce our cost basis by $1,700, reduce it by 85%, give us more capital to go do other strategies with. And instead of getting the $50 and 2.5% return on investment, now you're only getting $30. You're reducing your cost basis by 80%. You're also going to reduce how much money you're bringing in from the sale of that call option. You now get $30 on the sale of the call option, But because you're reducing your cost basis so dramatically down to $300, a reduction at 85%, now you have a 10% return on investment, which means the trade, from just a mathematical perspective, the trade makes more sense than the cover call.
Mm-hmm. I like the diagonal idea. The only question I'd have for you, Tyler, is could you go further out than the December? You know, I mean, could you map this out and get an extra bit of time? That way you could write cover calls against that underlying lead for quite some time if it does end up performing and behaving in the way that you want. Was there something about December just because of the way you like to play them? That was my only question.
So I think that many times people buy a 1-year option or 8 months or something, and they start with good intentions. But over 6 months, 8 months, 9 months, the stock's, falls out of favor or something, and it drops a lot. And you get stopped out. So I think oftentimes you start with good intentions. You pay all that extra money to buy that long term. Like if I went to March, for instance, bought the same strike. I mean, in this case, the cost isn't that big of a difference because it's a $19 stock.
Mm-hmm.
But oftentimes you'll pay hundreds of dollars more to go further out in time, and you'll still end up only selling 2 to 3 months against it anyways.
Sure.
So I would rather buy December, sell 3 months against it, reassess. If you still like it, rebuild the trade, close December, go buy another 6-month option. I feel like if you do that, your ROI is going to be better because you're not paying as much up front. So your return on investment is higher per month, and you're more adaptive. So if the price changes dramatically in the next couple of months, I can change my strike to a new one that's lower or higher depending on what I need. And that way, because oftentimes, Tim, let's say it works and the stock goes up like gangbusters, and your call goes deep in the money. Well, I kind of want to sell that anyways and buy a new one. I bought a 70 delta call. Now it's a 90 delta call. It's worth a ton. I don't need all that capital tied up. I sell it and buy another 70 delta. So you're probably going to make adjustments anyways. So why not just go with the cheaper route up front?
Makes sense. Makes sense to me.